Sunday, September 14, 2008. The building is still lit. Inside, thousands of employees are clearing their desks, packing personal items into cardboard boxes, riding elevators down for the last time. The phones are ringing. Nobody is answering. Outside on 7th Avenue, people are photographing the lobby, not because something great is happening, because something enormous is ending. Lehman Brothers, 158 years old, the fourth largest investment bank in the United States, and in a single weekend, without a government rescue, without a buyer, without a lifeline, it is gone. $613 billion in liabilities, the largest bankruptcy filing in American history. The question is not just how a bank this size failed. The question is what it took with it. To understand what was lost that weekend, you have to understand what Lehman Brothers had become. Not in some distant past, but in the years immediately before the fall. Because this was not a struggling institution. This was a firm that Wall Street respected, that clients trusted, and that competitors quietly envied. By 2006, Lehman Brothers was posting record profits. Net revenues had climbed to roughly $21 billion. Return on equity exceeded 20%. The firm's stock price had more than quadrupled in the decade since it went public. Dick Fuld, who had run the firm since 1994, was celebrated as one of the most tenacious chief executives in American finance. Fortune called him one of the best CEOs in the country. Inside Lehman, he was known simply as the gorilla, a term his employees used with something close to reverence. The firm had survived things that should have killed it. The Russian debt crisis of 1998, the collapse of long-term capital management, the September 11th attacks, which destroyed its offices near the World Trade Center. Each time, Lehman had come back harder, leaner, more aggressive. Each survival reinforced a belief that had become institutional doctrine, that Lehman was built differently, that it could absorb what others could not. And so, when the American housing market began its extraordinary expansion in the early 2000s, Lehman moved toward it, not cautiously, but with conviction. The firm acquired mortgage lenders. It packaged home loans into complex securities. It held enormous positions in commercial real estate. By 2007, real estate-related assets represented a significant portion of Lehman's total balance sheet, which had grown to nearly $700 billion, a figure larger than the GDP of most countries on Earth. The logic seemed sound at the time. Housing prices in America had not fallen on a national basis since the Great Depression. Lehman's risk models, like those of many of its peers, were built on that assumption. The models said the positions were manageable. The models said the leverage was acceptable. The models, it turned out, were measuring a world that no longer existed. What nobody on the executive floor was willing to say, what the quarterly earnings calls never mentioned, was that Lehman's leverage ratio had reached levels that left almost no margin for error. The firm was borrowing roughly $30 for every $1 of equity it held. In a rising market, that amplifies gains. In a falling one, it amplifies everything else. And by late 2007, the market was beginning, very quietly, very slowly, to fall. Here is what no one outside a handful of offices at Lehman Brothers fully understood in early 2008. The firm was not just exposed to the housing market. It was, in critical respects, the housing market. Its mortgage-related holdings were so large, so illiquid, and so deeply embedded in its balance sheet that any sustained decline in real estate values would not merely reduce profits, it would threaten the firm's survival. The U.S. housing market had peaked in 2006. By 2007, delinquency rates on subprime mortgages were climbing steadily. The securities built on those mortgages, the collateralized debt obligations, the mortgage-backed securities that Lehman had packaged, sold, and in many cases retained on its own books, were beginning to lose value. Not catastrophically at first, just steadily, persistently, in a way that the firm's internal valuations were slow to reflect. This is where the accounting becomes critical. Lehman used a mechanism that would later become one of the most scrutinized practices in post-crisis investigations. It was called Repo 105. The mechanics were straightforward. At the end of each financial quarter, Lehman temporarily transferred assets, tens of billions of dollars worth, off its balance sheet in exchange for short-term cash, treating the transactions as sales rather than loans under a legal opinion obtained from a British law firm. This reduced the apparent size of the balance sheet, and with it, the apparent leverage ratio, at precisely the moment when regulators and investors were reviewing the quarterly numbers. According to the bankruptcy examiner's report published in 2010, a document running to over 2,000 pages, Lehman used Repo 105 transactions to move as much as $50 billion off its balance sheet at the end of the first and second quarters of 2008. Once the quarter closed and the scrutiny passed, the assets came back, the leverage returned, and the public numbers, the numbers that investors, counterparties, and rating agencies were relying on, did not reflect the firm's true condition. The examiner's report found that these transactions were not disclosed to the public. It found that senior management, including the chief financial officer, were aware of the practice. It found colorable claims of malpractice against senior officers. It also found that Ernst & Young, Lehman's auditor, had been informed of the Repo 105 program and had raised no public objection. Meanwhile, the external pressure was intensifying. In March 2008, Bear Stearns, another major investment bank with heavy mortgage exposure, collapsed over a single weekend and was absorbed by J.P. Morgan Chase in a deal brokered by the Federal Reserve. The rescue sent a message to the market. The government would step in. It also sent a message to Lehman's counterparties. The firms most exposed to real estate were vulnerable in ways that had not been priced. Through the spring and summer of 2008, Lehman's stock price fell steadily. The firm raised capital. It announced asset sales. Dick Fuld held calls with investors, insisting the firm was well capitalized, that the worst was behind it. Internally, executives explored potential buyers: Korea Development Bank, Barclays, Bank of America. Each conversation stalled. Each potential partner looked at Lehman's books and stepped back. By early September, the firm's share price had lost more than 90% of its value from its peak. Credit default swap spreads, the market's real-time measure of default risk, were screaming. The funding that Lehman depended on to operate, the short-term borrowing that kept the engine running each day, was becoming harder to secure. Counterparties were pulling back. Prime brokerage clients were quietly moving assets elsewhere. The institution was experiencing, in slow motion and then very fast, a classic bank run. Not by retail depositors lining up at branches, but by sophisticated financial institutions withdrawing confidence one transaction at a time. The weekend of September 12 to 14, 2008, was conducted largely inside the offices of the Federal Reserve Bank of New York, on Liberty Street in Lower Manhattan. Timothy Geithner, then president of the New York Fed, had convened the chief executives of the major Wall Street banks. The message was stark. There would be no government bailout for Lehman Brothers. Whatever solution emerged would have to come from the private sector. Two serious buyers remained. Bank of America was one. Barclays, the British bank, was the other. Bank of America walked away on Saturday. It had found a more attractive target in Merrill Lynch, which was also teetering, and that deal was moving quickly. That left Barclays. Barclays was willing to buy Lehman. Its executives believed a deal could be structured, but there was a problem that would prove fatal. Under British financial regulation, a transaction of that size required shareholder approval, a process that would take weeks. In the interim, Barclays would need someone to guarantee Lehman's trading obligations, to stand behind the firm's open positions while the deal was being completed. The U.S. government declined to provide that guarantee. The Financial Services Authority in London confirmed it would not waive the shareholder approval requirement, and without a guarantee, Barclays could not proceed. The deal collapsed on Sunday morning. At approximately 1 in the morning on Monday, September 15, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection in the Southern District of New York. The filing listed $613 billion in debt, a figure so large it exceeded the combined bankruptcy filings of WorldCom, Enron, Conseco, Texaco, and Financial Corporation of America. Every previous record shattered in a single document. What followed was not an orderly wind-down. It was a detonation. Within hours, money market funds that had held Lehman commercial paper reported losses. The Reserve Primary Fund, one of the oldest money market funds in the United States, broke the buck. Its net asset value fell below $1 per share for the first time in its history, triggering a run on money market funds across the country, as investors, suddenly uncertain about what was safe, began pulling cash from instruments they had treated as equivalent to bank deposits. Credit markets seized. Banks stopped lending to one another. The London interbank offered rate spiked. The commercial paper market, the short-term borrowing mechanism that ordinary companies use to fund payroll, inventory, and daily operations, effectively froze. Firms that had nothing to do with mortgage-backed securities, firms that manufactured goods and ran supply chains and employed tens of thousands of workers, suddenly could not access the credit they needed to function. The U.S. government, having declined to rescue Lehman, found itself days later engineering the rescue of AIG, the insurance giant whose credit default swap exposure to mortgage securities had become a systemic threat, at a cost to taxpayers of $182 billion. The decision not to save Lehman, and the consequences that followed, would be debated by economists, regulators, and policymakers for years. What is not debated is the scale of what happened next. The deepest global recession since the 1930s, with trillions of dollars in household wealth destroyed across multiple continents. In the months and years that followed, the accounting was done. In courts, in regulatory offices, in congressional hearing rooms, and in the 9-volume report produced by bankruptcy examiner Anton Valukas, published in March 2010. The Valukas report found that Lehman's use of Repo 105 transactions had been used to paint a misleading picture of the firm's financial health in the quarters before its collapse. It identified colorable claims of malpractice against senior officers, including the chief executive and the chief financial officer. It raised serious questions about the role of Ernst & Young, the firm's auditor. Ernst & Young later settled a lawsuit brought by the New York Attorney General's office for $99 million without admitting wrongdoing, according to court records. No senior Lehman executive was criminally charged in connection with the firm's collapse. Dick Fuld testified before Congress in October 2008, stating that he had acted in good faith at all times and that he had taken steps he believed were in the best interest of the firm. The question of individual criminal accountability, which consumed significant public attention in the years after the crisis, ultimately produced no convictions at the senior executive level for conduct related to Lehman's failure. The broader regulatory response was substantial. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010, introduced new capital requirements, established a resolution mechanism for failing systemically important financial institutions, created the Consumer Financial Protection Bureau, and gave regulators new tools to wind down large banks without triggering the kind of market panic that followed Lehman's filing. Whether those tools would prove sufficient in a future crisis remained and remains an open question among economists and regulators. For the employees who carried boxes out of 745 7th Avenue on that Sunday night, the legal and regulatory debate was largely beside the point. Approximately 25,000 people lost their jobs in the immediate aftermath of the filing. Many lost significant portions of their retirement savings, which had been held in Lehman stock. The firm's global operations were sold off in pieces. The North American investment banking and capital markets businesses went to Barclays, the same bank that had been unable to complete a rescue 48 hours earlier, for a price of approximately $250 million, plus the assumption of certain liabilities. The European and Asian operations went to Nomura. What had taken 158 years to build was distributed in a matter of weeks. Creditors eventually recovered a significant portion of what they were owed. The estate paid out more than $130 billion to creditors over the years of the bankruptcy proceeding, a recovery rate that surprised many observers given the scale of the initial filing. But the broader damage, to pension funds, to mortgage holders, to the millions of people who lost jobs in the recession that followed, was never recovered on a balance sheet. The lesson that the Lehman collapse left in the regulatory record is precise and unadorned. A financial institution can be too large and too interconnected to fail without causing systemic damage, and yet still be allowed to fail, because the mechanisms to manage that failure in an orderly way did not exist. The gap between those two facts is where the crisis lived. Closing that gap is what the decade of reform that followed was designed to address. Whether it succeeded is a question the next crisis will answer.